An economic advisor's warning for investors to cut ties with companies reliant on China, despite it probably impacting returns.
The biggest risk, I think, on the horizon for Asia, frankly, is political in nature, and particularly the growing rivalry between the US and China. New Zealand firms need to understand that China is not the risk-free bet that it has been, and some of those risks are increasingly looming quite large.
It's Friday, the 10th of November, and you're watching Markets with Madison. New Zealand's economy is in deep with China. It's our largest trading partner, worth about 40 billion New Zealand dollars to us annually. But as tensions escalate globally, economic and policy advisor David Skilling thinks time is ticking on our attempt to play equally with the East and West. He believes listed companies that are linked to China's growth should de-risk and diversify immediately. Let me explain who is most concentrated on China. Agriculture is undeniably our ultimate export, and China our best buyer. But in the month of September, our dairy and meat exports there fell by 20% on the previous year. We also imported 17% less in cars and machinery from China. That downturn is impacting listed companies, especially the dairy sectors A2 Milk, Synlait and Fonterra. It could extend to other produce stocks, like the fruit exporter Scales Corporation, seafood company Sanford, and our wine exporters. Transport stocks are also tied to trade, potentially putting the port of Tauranga, Mainfreight, and Freightways in the firing line. It trickles down to tourism too. Auckland International Airport and Air New Zealand have previously benefited from in- and outbound travel with China, but that's not at levels that it once was. In a display of China's economic importance to New Zealand, our then Prime Minister Chris Hipkins visited the mainland in June to sign an expansion of our free trade agreement and meet with Chinese President Xi Jinping. That same month, the Ministry of Foreign Affairs and Trade released this assessment of the shifting global landscape, stressing a more assertive China, including over the Pacific, and raised the risk of conflict over the Taiwan Strait and South China Sea. In August, MFAT questioned how we can keep growth going with China, raising alarm over its record high youth unemployment rate and property slump. Kiwi turned expat David Skilling has told politicians and some listed companies here to de-risk from China's economy and geopolitical tensions. He's now extending that to investors, saying in this interview, don't wait for the politics to play out in your portfolio. Hey David, good to see you. Thanks so much for being here.
My pleasure, good to be here.
You admit in your written notes that I received that you're upbeat about China's economic prospects. So what is it about it that's making you cautious about investing in it?
I'm positive on Asia in a relative sense. So relative to, for example, Europe, where I'm sitting at the moment, Asia still looks dynamic and growing. It's got good demographics. The latest IMF forecast had emerging Asia growing pretty rapidly. India, for example, is growing at 6% plus. The ASEANs are growing at 5% plus, faster than China. So, the Asia story is increasingly broad-based, and it's pretty dynamic, as I said, compared to most other parts of the world. The biggest risk, I think, on the horizon for Asia, frankly, is political in nature. And particularly the growing rivalry between the US and China, the spillover effects from that. And, East Asia has got rich on the back of, supply chains, intense globalization. Some of those dynamics are at risk, and unfortunately that extends to New Zealand as well.
On that, and I know that you don't agree specifically with the term deglobalization as a complete trend, but you and I both know that economies around the world are definitely becoming more inward-looking, and that obviously poses the most risk to Southeast Asian economies that have been beneficiaries of globalization for decades. New Zealand absolutely is one of those. How prepared for that shift and change in earnings do you think that companies, but also governments, are in this corner of the world?
I think it's shifting. The thing for New Zealand in particular, I suppose, is physical remoteness has historically acted as a bit of a buffer. The world's problems are kind of over there somewhere, and we don't have to think about it so much. But I would say, that geopolitics is reaching closer to us. Obviously China is a very important market for New Zealand in a direct sense. About just under 30% of our merchandise trade goes to China. So anything that involves political risk around China matters for us. But historically, of course, New Zealand's maintained pretty good relations with China, certainly compared to Australia and many others. And so we haven't had the frictions in China relations that Australia and others have had. But I suspect we're not going to be able to dodge that for too much longer, either because something's going to go wrong in the bilateral relationship, through perhaps no fault of our own, but the surface area of problems is increasing, or frankly, a choice gets forced on us, either by China or by Australia or the US. So I think the risk profile of our relationship with China is increasing after 20, 30 years of a pretty benign environment. But I suspect that many New Zealand firms are still catching up with that new reality. It's not unique to New Zealand. It's the case for, look at German firms, for example, they were taken by surprise by Russia invading Ukraine. So it's not unique to New Zealand. But I think we have to understand that geography is no longer a complete buffer for us.
So effectively, our Switzerland stance politically is going to have to change. But what does that mean for companies? We have so many companies down under that are enormously reliant on China's economic growth story. So what should they do?
Well, I think they should realise that the risk profile has shifted. I mean, obviously, there's an economic risk profile around China. The Chinese economy is slowing. It's not going to grow at 7-8%. It's going to grow at 4-5% and below. So there's a set of economic risks around China that didn't exist. But also, clearly, there are a set of political and geopolitical risks that we need to manage. And so you should think about China in a risk-adjusted sense. There's a series of risks that need to be actively managed. And so, approaching geopolitical risk around China is not a binary proposition. It's not on or off. The issue is really understanding the risk and figuring out what risk tolerance you have as an organization, as a company, and indeed as an overall economy, and how we want to de-risk. So de-risking is the term of the day, certainly in Europe and the US. Decoupling is too extreme, but de-risking is really what sort of risk do we want to have on our balance sheet, on our P&L? Do we want to be thinking proactively about de-risking? That could be diversifying markets. It could be rejigging our supply chains. But again, I think New Zealand firms need to understand that China is not the risk-free bet that it has been. And some of those risks are increasingly looming quite large.
When you were back in New Zealand recently, I know that you met with some of our listed companies, and I've no doubt you told them exactly those words. So what was their response?
Well, I mean, these are, in the main, pretty smart, pretty well-informed people. So there is a sense that, the risk profile is shifting. I think, from where I sit in Europe, most recently been 11 years in Singapore. So looking at the rise of China in a pretty kind of up close way, I'm not sure that we fully appreciate the speed and intensity of the change that is occurring. I think there's a sense that these changes are kind of occurring, yes, but occurring in a fairly gradual manner. Whereas I actually think that some of these changes are appearing, are manifesting in a more rapid, disruptive way. And again, the number of tail risks that we've seen in the global economy, be it Hamas in Israel, be it Russia, Ukraine, any number of things, that the incidence of tail risks is increasing. And so I think my concern is not that it's a black swan. It's not that we're completely unaware of these risks, but we underestimate the magnitude and the intensity of the shock. And so we're not fully prepared for that. I think there's also a sense of, New Zealand's always quite good at scrambling. So through the pandemic, big shocks, supply chains, unprecedented disruption, and through good management and a bit of good luck, we kind of scrambled. We got pharmaceuticals, we got PPE, and we managed. And I think, in general, the New Zealand way is a bit the number 8 why mentality. If bad things happen, we will respond as they happen. The world is just too uncertain to predict. So there's no point expending too much mental energy or budget, trying to manage risks that may not actually occur. So I think my concern is not that we're unaware of these things, but one, we discount them a bit too much. And secondly, we back our chances to scramble when a bad event happens. And I think the concern with that is that, these things are too big to scramble in response to. And by the time these things happen, if we continue with path of least resistance, we are going to be accumulating a bunch of risks on the way through. So, again, it's not that we're unaware. I just don't think we're responding with quite the degree of intensity that I see in other parts of the world.
I will raise, though, a potential investor return risk if they do start de-risking from China. The China economic growth story is currently good, especially compared to many other economies around the world. They just booked 4.9% Q3 GDP, which was better than most expected. So is there not a risk that investors de-risk from China too early they'll actually miss out on good return?
Yes, and so that's that's a more serious objection to de-risking. You're essentially paying an insurance premium. You're giving up some profit, some margin, to de-risk against a future outcome that may or may not happen. And if you're the only person in your market that's paying that insurance premium, you're going to lose market share. Your shareholders or your board is not going to be happy. So, there are legitimate concerns, commercial concerns with moving too early. But on the other hand, if you don't move and you accumulate significant risks and that bad event does happen, it can be a first-order commercial sort of concern for you. So, again, de-risking is not a binary proposition. The issue is how much risk do you want to have on your balance sheet? What sort of insurance premium do you want to pay? And it's really it's making a judgment. And I guess I would say that the terms of that trade-off are shifting. Risks are coming closer to home. I think at a country level, choices are going to be forced on us that do have commercial implications for firms that are exposed to China. And firms need to be going through a sort of a structured, disciplined process, figuring out, what risks are you comfortable with taking? What's your plan B? What are the scenarios against which you want to test your strategy? And thinking about this very seriously. The answer is not obvious, and the answer also will vary by country, by company and by sector. But we can't afford to be either fatalist or complacent. This needs to be addressed and considered, I think, very seriously.
Strong words from you, David. I think that pretty much sums it up. Thank you so much for your time. Always interesting chatting to you.
My pleasure.
China's economic growth story is a big topic of conversation in markets down under right now. It's even been mentioned as a risk by the Reserve Bank of New Zealand. If you invest in any companies that rely on China's growth, I want to know how you're thinking about this. Let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.